Consistency, the holy grail of trading, is the thing every trader desperately craves. They want those steady, beautiful profits, week after week, without the sickening, chaotic roller coaster ride of huge wins immediately followed by devastating losses. They want the calm, predictable rhythm of success. Yet despite this deep universal desire, very few traders ever truly achieve it. It's the most elusive prize in the financial world. Why is it so rare? The answer isn't buried in some secret chart pattern. It's not because the market is rigged, as many frustrated traders like to complain. The real fundamental reason is that consistency isn't a trading problem. It's a profound psychological one. And until you understand this truth, you'll be trapped in a relentless, exhausting cycle, chasing a result you are structurally unprepared to keep. The illusion of the beginning. Think about the moment most traders start. They stumble into the world of trading, often through a friend's boasting or an exciting social media post about getting rich quickly. Excitement takes over. It's a rush. They study charts, cram technical terms, memorize candlestick patterns, and finally build or copy a strategy. When they start trading, the market often gives them a few wins right away. This early success feels like absolute confirmation. They think, "I've cracked the code. Consistency is mine." They feel invincible. But this early stage is a trap, a cruel deception. Then reality hits like a brick wall. A losing streak arrives. That strategy, which seems so solid, so bulletproof, suddenly looks completely broken. Fear, doubt, and paralyzing frustration creep into the decision-making process. The trader immediately starts tweaking, abandoning the old strategy, and frantically chasing a new one. Before they know it, they are caught in the endless, destructive cycle of inconsistency that kills most trading careers. This pattern is so common because the initial win is pure luck or a function of simple market conditions. But the reaction to the first loss is pure, unmastered emotion. The first mistake most people make is expecting consistency from the market itself. The market will always be inconsistent. It will surge, then crawl sideways, then react violently to news, then completely ignore it. The market is chaotic, ever-changing, and irrational in the short term. It is not built to provide you with steady, predictable returns. That's why the consistency you're looking for has to come from one source and one source only: you. It must come from your unwavering behavior, your rock-solid mindset, and your ability to execute your plan the same exact way, every single time, no matter what the market is doing. The failure of strategy and the power of mindset. Most traders believe that if they just find the perfect strategy, consistency will magically appear. This is deeply flawed thinking. Strategies don't create consistency. The trader's discipline does. You can take the best, most statistically proven strategy in the world and still fail to make money with it if you lack the emotional fortitude to follow it through a drawdown. You will not manage risk properly, and you will allow your impulses to hijack your actions. Conversely, a trader armed with a simple, even basic, strategy can achieve profound consistency if they possess the right mindset and the ability to apply that simple edge relentlessly. Over the long run, the core problem is that the human brain isn't naturally wired for consistency. We are wired for survival. And survival mode in trading manifests as two destructive forces: fear and greed. Fear pushes you to close trades too early, to skip high-quality setups, or to abandon your system after a couple of losses. Greed pushes you to over-lever your positions, chase trades that have already moved, or cling to winners far past the target, hoping for a mythical more. Both fear and greed create impulsive decisions, and impulsive decisions are the systemic destroyers of consistency. Every time you act on impulse, you break the chain of disciplined behavior that is necessary for stable, compounding results. Look at the evidence. A trader wins 3 times, feels invincible, and doubles their position size, an act of greed. That one decision can wipe out the profits from the previous 3 trades. On the flip side, another trader loses 3 times. Instead of following the strict risk rules, they take a much bigger trade to make it back, an act of fear and desperation. The market doesn't care. It moves, and now a small, manageable loss has turned into a massive account blow. This is why consistency feels impossible to achieve. It's not the system. It's the trader's inability to manage themselves when emotions take charge. Becoming the casino. Process over. Outcome consistency is achieved when you stop treating trading like a game of chance and start treating it like a process-driven business. Think of a casino. The casino doesn't know which individual spin of the roulette wheel will win. It doesn't care which gambler leaves rich tonight. Why? Because the casino understands that over time, the tiny house edge guarantees long-term profitability. They focus relentlessly on process, not outcome. That is precisely how you must learn to think. You don't need to win every trade. You don't need to predict the market's every twist and turn. You just need to consistently apply your validated edge, manage your risk with iron discipline, and let the laws of probability play out over time. That is the critical mental leap that moves you from gambling to consistent trading. The challenge is that you know this in theory, yet you fail in practice. Why? Because theory doesn't prepare you for the emotional firestorm. Reading about discipline doesn't make you disciplined. The only way to build consistency is to train your mind through repetition, just like lifting weights at the gym. You have to do the same right thing over and over again until it becomes an automatic second-nature response. It's not flashy. It's boring. But boring is what makes traders consistent. Most traders don't want boring. They crave the excitement, the adrenaline, the feeling that every trade is the big one. And that emotional need for excitement is exactly what sabotages their chance at stable growth. If trading feels exciting all the time, you are almost certainly doing it wrong. Real consistency feels calm, structured, and predictable. Not in terms of what the market will do, but in terms of your own rock-solid, predictable behavior. The cycle of strategy. Hopping and mismeasurement, one of the biggest killers of consistency, is the endless search for the next best thing. A trader faces a few inevitable losses and immediately decides their strategy is broken. They abandon it and start hunting for a new one. They test that one, face another necessary losing streak, and abandon it again. This endless cycle of strategy hopping keeps them stuck in inconsistency forever. The reality is that every single strategy has losing trades. Every edge goes through drawdowns or periods where it temporarily performs poorly. The difference between the trader who makes it and the one who doesn't is simple. The consistent trader stays the course while the inconsistent one panics and abandons ship. Another hidden problem is that traders measure success in the wrong way. They think consistency means winning every single day or making a profit every single week. That is an impossible standard. Even the world's best professional traders have losing weeks and sometimes even losing months. Consistency is not about daily profits. It's about adhering to your plan and executing your edge over hundreds of trades. If you zoom out far enough, if you look at the big picture, the small losses and setbacks don't matter. What matters is the long-term upward curve of your equity. But because most traders are obsessed with short-term immediate gratification, they never stay consistent long enough to reap the long-term rewards. Breaking the cycle. Process over outcome. How do you finally break this destructive cycle? It begins with a mindset transformation. Stop asking, did I win or lose this trade? Start asking, did I follow my process correctly? That is the only question that matters. If you followed your plan perfectly, the trade was a success regardless of the outcome. If you didn't, then it was a failure, even if you happened to make money by pure luck. This way of thinking trains your brain to value discipline over results, and that is the absolute foundation of consistency. The second huge step is to completely detach your self-worth from your trading results. When you tie your identity to wins and losses, a losing day makes you feel like a fundamental failure. This emotional roller coaster prevents consistency because you're always chasing the highs and desperately avoiding the lows. You are not your profit and loss. You are the executive operator of a statistical process. When you learn to separate yourself from the temporary outcome, you stop overreacting and start building emotional stability. Finally, you must accept that consistency is not a destination. It's not something you achieve once and keep forever. It is a daily practice, a discipline you recommit to every single morning. The moment you drop your guard, the moment you think you've mastered it, inconsistency will creep back in. The best traders are the humble ones. They know consistency is not about perfection. It's about constantly managing yourself, your emotions, and your discipline so that over time, the math plays out in your favor. If you are struggling with this right now, understand this simple truth. The successful stop looking for consistency in the market and start building it within themselves. They stop chasing shortcuts and start mastering the necessary, grueling work of discipline. And once you truly grasp that, everything shifts. Consistency stops being an impossible dream and starts being your daily reality. The battlefield of the mind: fear, greed, and impatience. The market does not require perfection. It requires that you stick to your plan long enough for probability to work. But the battlefield is always in the mind. Fear is a great destroyer. It whispers, "What if this fails? What if it reverses the moment you enter?" Fear appears because the mind hates uncertainty and is wired to avoid loss. In trading, that instinct is a double-edged sword. Fear pushes you to cut trades too early, move stop losses out of delusion, or hesitate until the opportunity is gone. When you act out of fear, you abandon your plan and follow survival instincts that are financially lethal. Fear's twin is greed. If fear makes you cut too soon, greed makes you hold on too long. You set a target, but when the price hits it, greed convinces you, "I could double this win." This refusal to be satisfied with the plan often leads to the pain of watching a clean winner slip away as the market reverses. Then comes impatience, the silent killer. Sitting through quiet price action feels like torture. Instead of waiting, the trader invents opportunities, taking mediocre trades just to do something. These poor decisions lead to losses, shaking their confidence and causing them to miss the real high-quality setup when it finally arrives. Impatience punishes not once, but twice. On the opposite end is overconfidence, usually following a streak of wins. The trader believes they are infallible. Rules become unnecessary suggestions. Risk management is ignored. One large, reckless loss then wipes out the gains of 10 good trades. A consistent trader never allows short-term success to cloud the necessity of long-term discipline. The pillars of true consistency. Consistency is not a mystery. It is a discipline built on clear, repeatable steps. Clarity, no vague rules. You must know your entries, exits, risk tolerance, and trade management rules in painstaking detail before the market opens. Clarity eliminates guesswork. Trust. You must trust your system and the math. If you've tested your strategy thoroughly, a losing trade is not a failure. It's a part of the statistical story. You must have faith in the long-term probabilities, even when the short-term outcomes are painful. Routine. Consistent traders live by routines: pre-market preparation, focused execution, and post-market review. Routine builds a mental structure that keeps emotions out of the decision-making process. Patience. The market is not a quick money machine. It is a lifelong craft. The more you chase speed, the longer success takes. The more you accept patience, the faster success arrives. Detachment. You are an operator of a system, not a gambler. Detachment creates emotional stability. You are not celebrating like a king or collapsing like a beggar. You are simply following your plan. Emotional mastery. You cannot eliminate emotions, but you must observe them without being controlled by them. A consistent trader feels fear but does not act on it. They feel greed but do not let it override their rules. Humility. The market is bigger and smarter than you, and it owes you nothing. Humility keeps you disciplined because it reminds you that you are not in control of outcomes, only your own actions. Consistency is not a myth. It is not a secret. It is a choice. It is the choice to follow your rules, trust the math, and execute your plan with unwavering discipline when everyone else is crumbling under the weight of their own impulses. Your future is shaped not by luck, not by chance, but by the discipline to be consistent when everyone else is not. The moment you master discipline, you stop chasing the market, and the market starts rewarding you.